When a bank underwrites a traditional term loan, the credit exposure is a fixed, known quantity at origination. You lend $1 million, and your maximum day-one exposure is exactly $1 million. The principal slowly amortizes on a set schedule. Move into wholesale banking, prime brokerage, or derivatives, and that certainty vanishes. True exposure becomes stochastic. It is bilateral, meaning either party could owe the other, and it fluctuates every second based on underlying market variables. This creates an immediate mathematical problem. How do you provision for a potential default when your exposure to the borrower, their probability of defaulting, and the underlying market prices are all moving simultaneously? To solve this, we have to look past isolated formulas and build the architecture of advanced credit risk from first principles. We will construct this system in 3 distinct phases: mapping dynamic exposure, pricing the precise timing of a default, and engineering structural protection through cash flow waterfalls. Modern credit risk operates as a highly sensitive, interconnected mathematical engine. To understand how capital markets survive stress, you must understand how this engine is built. The first requirement is quantifying counterparty credit risk. Consider an FX forward contract. Unlike a traditional loan, the amount you might lose depends entirely on exchange rates months in the future. Both parties carry risk. Because this exposure is driven by market volatility rather than a fixed repayment schedule, regulators require a standardized method to calculate exactly what is at risk. This sine wave tracks the mark-to-market value of a bilateral contract over time. To capture the risk of this fluctuation, the Basel SA-CCR framework uses a strict equation. Exposure at default equals a regulatory multiplier, alpha, applied to the sum of replacement cost and potential future exposure. We freeze the curve to find the replacement cost. This is the immediate, real-world loss the bank would suffer if the counterparty defaulted at this exact second. It is what you are owed today. But the trade isn't closed. The probabilistic fan that expands out from today's value represents potential future exposure. This calculates a high percentile statistical buffer, usually the 95th percentile, mapping how much worse the market could move against you before you can safely close out the position. Potential future exposure dictates worst-case limit setting for risk management. For average expected loss pricing, banks use the mean of this distribution, known as expected positive exposure. By adding today's fixed replacement cost to tomorrow's statistical worst-case buffer, SA-CCR forces volatile derivatives into a static loan size equivalent. Banks can now assign a hard capital charge to a constantly moving target. Defining regulatory exposure is only the baseline. Banks also have to price this counterparty risk directly into the derivative's daily profit and loss. This requires a credit valuation adjustment, or CVA. This visualization shows CVA in action. It is the mathematical intersection of market risk and credit risk. One curve projects your expected positive exposure over time. The second curve maps the counterparty's marginal probability of default. Multiplying these two variables together at every future time step and discounting them back to today generates the shaded area under the curves. This area represents the expected loss from a counterparty default over the life of the derivative. Under normal market conditions, this is a stable calculation. But a severe systemic vulnerability hides inside this integration, known as wrong-way risk. Wrong-way risk occurs when your exposure to a counterparty increases simultaneously as their credit quality deteriorates. For example, buying credit default swap protection from a bank whose own financial health is highly correlated to the exact entity you are hedging against. When correlated stress hits, the variables do not remain independent. The exposure wave and the default probability wave simultaneously spike. Because they are multiplied together, the expected loss area explodes exponentially, resulting in massive, unexpected capital charges. The math reveals the danger. The diversification and hedging protection you paid for evaporates at the exact moment the market turns against you. The accuracy of that CVA calculation depends entirely on the probability of default curve. For modern provisioning under IFRS 9, we have to calculate how that default curve is actually generated across the lifetime of an exposure. Standard point-in-time logistic regression models fail here. They predict a binary outcome over a fixed 12-month horizon. They cannot model when a default will occur over a multi-year timeline, and they struggle with accounts that close out early without defaulting. We observe this Kaplan-Meier curve to solve the timing problem. Using survival analysis, we track individual borrower timelines, handling censored data correctly, and aggregating them to plot the exact probability of an account surviving past any given month. From this survival curve, we derive the hazard function. Real-world defaults and exposure limits are necessary, but banks do not hold single loans. They aggregate thousands of individual risks into massive portfolios. In a Monte Carlo loss simulation, the dominant driver of portfolio tail risk is the asset correlation parameter, ρ. When ρ is low, defaults offset each other. When correlation spikes, risk clusters into catastrophic simultaneous downward movements. Relying on the Gaussian copula to map this correlation is what caused models to fail during the 2008 financial crisis. The normal distribution assumptions massively underestimated the probability of these extreme clustered tail events. Real-world defaults are not statistically independent. During severe market shocks, businesses face the same macroeconomic pressures, and their failures cluster violently. To defend against this correlated loss, the capital markets engineer structural protection using the securitization waterfall. Cash flows distribute from the top down, but losses are strictly absorbed from the bottom up. The unrated equity tranche acts as the first loss shock absorber. If clustered defaults exhaust the equity tier, the mezzanine tranche begins taking hits, shielding the investment-grade paper at the top. The total volume of these subordinate tranches provides credit enhancement. Combined with over-collateralization, where the underlying asset pool is physically larger than the issued notes, the system mathematically walls off the senior tranche from early defaults. Furthermore, applying sequential paydown logic ensures that all incoming principal repays the senior investors first, rapidly deleveraging their position before backloaded defaults can materialize. Securitization does not eliminate risk. It is the physical plumbing that dictates who absorbs the damage when systemic correlation spikes and losses cascade. We have now built the engine. SA-CCR defines the exposure. Survival analysis sets the default timing. Securitization structures the loss distribution. To see how these models behave in reality, we subject the entire interconnected system to a macro shockwave. The trigger event is a sovereign default in an emerging market. Government debt obligations fail, immediately repricing the sovereign risk premium across the region. This triggers a secondary, more localized crisis, transfer and convertibility risk. Capital controls are imposed, the local currency collapses, and even healthy private companies are suddenly blocked from converting local revenue to service their foreign debt. The contagion hits global trade finance portfolios next. As buyers fail to pay and letters of credit are drawn down, supposedly self-liquidating short-term exposures freeze, locking up billions in working capital on the water. The shockwave travels back into our mathematical engine. Across the bank's book, hazard curves aggressively steepen as covariate data updates. Counterparty exposures spike due to currency volatility, driving up expected positive exposure precisely as probability of default jumps. In response to failing pool assets, the securitization waterfalls automatically snap into defensive modes. Over-collateralization triggers breach, immediately trapping cash and shutting off distributions to mezzanine investors to protect senior bondholders. This creates procyclicality. The regulatory models require banks to aggressively downgrade borrowers, increase provisions, and cut lending simultaneously. The mechanics built to protect individual balance sheets inadvertently amplify the severity of the macroeconomic crisis. True credit risk mastery is recognizing that equations do not operate in a vacuum. They form behavioral feedback loops, highly sensitive to macro shocks, and ultimately they are only as robust as the assumptions holding them together.